Adrian Mowat joins us, represents, he's tracked emerging markets and equity markets with a magnifying glass. Adrian, the only thing which we need to figure out now is that how much of the bad news is in the price and how much of the bad news still needs to be digested by the market.
Not sure if it's the only thing. That there are a lot of factors at play here, but the key issue is what's going to happen with the US tariff regime. And that's still a massive area of uncertainty. To some extent, you could say, well, we've had Liberation Day. He's told us what tariffs are going to be in place. Clearly, those tariffs, the way the calculation was done, is all about compressing current account deficits and doing that readjustment. The tariffs were far higher than was expected by the market, and hence we've had significant corrections in global equities. I don't see a near-term end to this level of uncertainty around these tariffs. You could make a reasonable argument that the tariffs are all about a negotiating stance and that President Trump will do deals. And if that happens, then I think the market will get some reassurance. There's also another credible case, which is that the Trump administration sees tariffs as a revenue-generating source, that it's neat that if you wanted to get rid of income tax on 97% of the US population that earns less than $150,000 a year, then the cost of that is about $600 billion. This is what they're estimating they're going to bring in tariffs, and that maybe President Trump thinks that's a very neat thing, and his intention is to remain resolute and keep these tariffs in place. Now, the tariffs, if they do remain in place, it is highly likely that we will get a recession in the United States. The mechanism is very clear. You're going to compress household incomes because the cost of goods are going up. Their ability to buy these goods, such as iPhones, etc., will go down. That recession will be compounded by the collapse in business confidence. Remember, in the United States, most jobs are generated by small to medium-sized businesses who are incredibly vulnerable to these tariffs moves. And so the equity market is trying to price that in. And you're trying to price that in an equity market that's still 20 times forward based upon earnings growth of 10% in the United States. And so that doesn't look like a market that is yet priced for recession. So I think the worst is probably not over for US equities. Now, how that translates into equities elsewhere in the world, well, we've got our correlation issue. We've also got an issue which relates to slowing US growth and the impact of these tariffs. And we're seeing that playing out quite aggressively in the commodity markets. You saw copper coming off a lot. I think petrochemical prices will be an issue. You'll see refining margins narrow. So cyclical sectors globally are going to be hit by this in a contagion way. So I think the sell-off has been horrible, very aggressive, but it may not have got us quite to the level that we need to be in order to reflect the significant deterioration in fundamentals.
That's of course one side of the story, and who knows how this is all going to really settle down. But what should investors do? Do they wait it out for that one perfect opportune moment when there is complete clarity on tariffs? Or is the time now to start deploying in cash, at least little by little?
So what you should be doing now is analyzing your potential investments. So this is not the time for sort of rapid trading in the market. You go and look at the company that you're intending to invest in, look at its sensitivity to this new US policy, both the first and the second order effects, and then consider whether the valuation of that investment is giving you sufficient comfort to deal with this higher volatility, higher risk world. That's what we need to be doing in this situation. And I think when you start to do that in the large caps in India, unfortunately, you come out with the conclusion that there isn't sufficient valuation cushion at the moment for you to be wanting to commit meaningful capital. You know, you look through your large cap names, even after the big sell-off, you're getting multiples of sort of 20 times forward. And it's likely that, let's take a name like Reliance, you'll get, you know, further downgrades of earnings just because of compression in the margins it can get on the products that it sells. You know, something like an Emphasis, which has also been hit very hard, I think down 35+%, still on 20 times forward. You know, it could be vulnerable because effectively it is exporting services to the United States, to the tariff regime. You know, Mahindra also on 20 odd times forward, based upon earnings growth. And, you know, we can, you know, wonder what the impact is going to be on the global auto sector. You know, if you can't sell into the United States, does that mean more of a glut of autos in other markets? And that results in a sort of general compression of margins. So as I go back to my first point, which is run the numbers, you know, do some reality checks here. And are you saying, oh gosh, these things have sold off, they're incredibly cheap. It's comfortable for me to buy them now because even if I don't make money over the next couple of quarters, I'm comfortable I will be making money 1-2 years from now. And at the moment, I don't see those numbers out there in the Indian market.
If markets go down and if asset changes happen, Adrian, where would money move? Historically, when there has been problem in the world, money has always gravitated towards US Treasury or the dollar. Right now, they both are under pain. So where would money gravitate?
Yeah, so I think the answer, it gravitates to local currency, right? So, you know, remember the US, as Trump's very disturbed by, has been running current account deficits for many years, so it's relied on other people's savings. If the US is perceived to be becoming less friendly economically, general defense policy, etc., then you repatriate capital. So that money can sit in euros, it can sit in Swiss francs. You've already seen it's been sitting in the gold. It can come back into renminbi. It can sit in the yen. You know, the yen's been appreciating quite nicely. So I think it's, you know, you bring up a very good point because normally in these big risk off moments, the dollar rallies. But I do think we're in a different environment. And that the dollar strength, which has been considerable, because despite what President Trump says, the US economy has been one of the best major performing economies in the world. US exceptionalism, that attracted a lot of capital and drove the dollar higher. The dollar bull market is over. And, you know, we're going to be happy to take a lower yield in euro, but actually make more money because the euro appreciates. And I'll make the same comment about the yen, the Swiss franc, maybe even the Indian rupee, you know, stops to appreciate.
The fluid situation, but we'll take each day as it comes, I guess. Adrian, good chatting with you. Thank you for your time.
If you like this video, then like, share and subscribe to ET Now.